Hey traders, this is Blake Morrow with Traders Summit, and with me again, and it's been way too long, I have David Bell, founder of Macrodesiac. How are you, David? Good to see you again.
I'm all good, Blake. Thanks a lot for having me on.
Man, I want to say the world has changed dramatically since the last time we spoke, and we spoke back in January. You were actually bullish yen, and you were selling some CAD yen. I think your trade was because of oil prices and the yen. And tell me what happened, because obviously a lot's changed since then, and we've seen the yen weaken substantially. But that doesn't mean that that's how you traded it. Let's talk about how you traded that environment before things really changed over the last couple of months.
Well, firstly, it got blown out of the water, didn't it?
Yeah, it sure did. And all yen pairs did. And it wasn't just the Canadian yen, it was dollar yen, every yen pair. So but yeah, it blew out of the water. So how'd you trade it?
I think I was short from a few positions between 89.5 all the way up to about 91. And my thinking at the time was that Canadian debt levels are excessively high. I thought that we were reaching sort of the end of the COVID period, and there wasn't much appetite for lockdowns and things like that. So I thought that the Canadian economy would come more into view. And then, of course, we started to hear more and more murmurs about Russia invading Ukraine. And then, of course, it did happen. But I think one of the biggest problems with that trade for me and how I managed it was that I was probably in it for too long a time without it doing anything.
Yeah.
And I think I've reassessed that, and I've worked out that just because I'm trading longer term themes doesn't mean that I have to sit through and bear like a really boring sideways market for a long time. I think coupled with the view of wanting to be long yen, which I don't think was that contrarian a view at the time, because we were seeing inflation tick up, and considering Japan's previous stance on inflation.
Yeah.
They did want it, but I was looking at it from a policy pivot perspective. So they didn't necessarily have to act on it, but I thought they would have more hawkish language than they did. And even up until when the yen's been decimated, last week, they're still saying that we're going to add more easing. And, the 10-year yield's ticking up against that yield cap at 0.25%. And I think, it kind of is a bit paradoxical in my head in terms of what they're saying. They're so close to 130 where they've signaled that they want a stronger yen, but then they go and say last week that they're going to keep buying aggressively. So it's a bit of a confusing one, and potentially there is some case to be made in the next couple of months that there is a lot of volatility that's going to come through into the yen, but the other way perhaps, because I think they.
So with that being said, you're trying to, or you can start to build a case, or you're trying to build a case to be long yen in the coming, let's just call it weeks or months ahead.
I think so. I think if you look at retail sentiment, they're still heavily short dollar yen specifically. I think that needs to decline a lot before we can start to really make a case for the fundamental side of things come into fruition. If you've got a really heavy book, it's one of my favorite indicators. If there's a really heavy book, like last week I saw 74% of traders at IG were short dollar yen, and when you tend to see that, the squeeze is on. I use IG as a barometer because of the amount of clients that they have, so it's a good overall picture of where retail are looking. So I think we need to see that decline rapidly, perhaps into 130, and then we see what the BOJ says, and whether things actually start to make sense for a stronger yen.
You'd mentioned a little bit about yields and how you're watching the 10-year. Do you think the 10-year and dollar yen still have a pretty strong correlation? Do you think that's one of the, or let's just say the yen in general, do you think that's one of the catalysts that has really driven the yen lower?
I think yes, it's definitely down to yield differentials. Like, even though the Japanese 10-year is reaching that yield cap, there's still such a massive differential because the US 10-year yield has accelerated so quickly to the upside. But we are approaching that 40-year three standard deviation level to the upside on the US 10-year yield, which is at about 3% to 3.25%. So it'd be very, very interesting to see what happens there. I mean, if we go higher, then the bond vigilantes are finally right for once in their lives, you know. But I just feel like with Bullard's comments last week about bonds not being a safe place and all of this kind of thing, that gives me a nice bit of sentiment to play against. If you know, if a Fed member's saying that, then it's like seeing, you know, an Economist cover of this is the end of the dollar, and it's like the dollar rallies like 500 points or something like
that. Well, you know, since we're on the topic of yields and yield differentials, let's talk a little bit about what that means in terms of, you know, like real rates moving higher, you know, and how it's going to affect like the consumer and maybe housing. You know, you live in the UK and you live just outside of London. Is that correct?
Just inside. So
just inside of London. Okay. In the city of London. I live in and I'm assuming it's a pretty hot real estate market. I live in a place that the real estate market is really hot as well. You know, with yields rallying and with the expectations that they're going to continue to move higher. How do you feel? Well, let's start with housing first. How do you feel about the housing market and the housing market in general moving forward? And then we're going to talk about inflation.
So I think there's an interesting sort of I guess connection, that I saw the other day, which is between XHB, which is US house builders ETF, and Case-Shiller year-on-year prices. Now, XHB is the worst performing sector, or house builders is the worst performing sector so far this year. And the correlation is really, really strong between house price growth and that specific ETF. And there tends to be, you know, quite a nice lead. Obviously, the Case-Shiller is monthly released, and XHB, you know, trades every day, and that's down massively. And the last Case-Shiller data drop was, I think, early March. Can't really recall. So, you know, if that correlation is confirmed with the next data drop, then I think we might see quite a large decrease in house prices generally. You know, I think amongst certain tiers of property, it's, you know, it's kind of more sticky. You know, maybe the luxury market, perhaps that's a lot more sticky. But yeah, I think we're going to start seeing falls in the housing market. And, you know, once we start seeing that, the housing is very much, it's pure wealth effect. Right? I've got a lot to say on land and how land should be taxed and how we shouldn't have tax on incomes and capital, because, you know, just sitting on a piece of land is really unproductive. Like, you're not earning anything, you're just playing value being added from other people's sort of input, basically. But that's for another day. But the wealth effect, you know, it's like if house prices stop going down, you know, there's going to be less equity release going on. There's less credit flowing through the economy, and sentiment sours. So the connection, I really, really think, and what tends to go first is, if housing really starts to go first, then equities will follow pretty heavily as well. And so my eyes for the last couple of weeks has been really, really on the housing market. You know, we saw a degradation in the Chinese housing market, and specifically, obviously, amongst the Chinese developers. And there's always sort of a domino that starts somewhere. You know, the effects of China currently having a massive impact on Aussie, for example. Aussie dollar's down big time over the last week or so. Yeah. And, you know, I do think that the Chinese market is sort of it's not a ticking time bomb or anything like that, because it's a totally different type of economy to the West. You know, the CCP are essentially a mafia, so they can control the market if they like. But I do think that it's kind of symptomatic of the debt-based expansion and reliance that we have on the wealth effect that stems from housing. And, you know, I think boom and bust cycles are predicated on housing.
So if you take this downside, possible down cycle in housing, and it's really going to affect consumer spending, it's going to feed us into inflation a little bit. I want to ask your opinion on inflationary pressures that we're seeing. I mean, at what point, David, do consumers just say, you know what, I'm not buying it. I can't buy it. I can't buy it, or I'm not buying it. And, is that going to feed into, even what you're talking about as far as housing goes? Because you get that wealth effect, and the wealth effect is great while you got it, but in reverse, it shifts the consumer a little bit, right?
Yeah, no, for sure. I think a good example of this was a survey done today in the UK with regards to energy prices. 48% of people said that they either couldn't afford to pay their energy bills, or they would be, really, really hard up to be able to reach it. 48% is massive.
That's a big number.
I've seen, I mean, my energy bill has gone from, okay, so I was paying about £110 a month for both gas and electric. It's gone up to £300 a month, and that's with a direct debit, so that they know each month that they're getting, a couple of £100. So it's a little bit cheaper than what it should really be. And
that's amazing. I've actually heard similar stories in different parts of the Eurozone as well. So yeah, just letting you continue on. But how's that going to affect the consumer? I mean, at what point do they just say, I'm not doing it?
Well, this is the thing. It's like, I think a lot of people are. I think, if you go through Twitter and type in like UK energy or something like that, you can find responses from people, and they're like, I literally just can't afford this. It's quite crazy. I mean, one of the benefits is that UK natural gas prices have actually fallen over the last couple of days. So hopefully that provides some relief. But these energy firms, they're going to keep prices quite sticky. I think they lost a lot of money in 2020. They made some money in 2021, but at the end of the day, they can't. It's like menu costs, right? They can't just keep chopping and changing it all the time, because that in itself costs money. So yeah, I think it's really, really difficult for the consumer at the moment.
So let me ask you then. I'm going to ask you two questions. I want to ask you: I guess this would be a few questions, but are you an inflationist, deflationist, stagflationist? How about that? What camp do you fall into?
Well, I think it depends on time frame, of course. I think it depends on time frame. I think I am so with the transitory thing, right? No one's ever actually defined really what transitory is. So I made up my own sort of more objective, I like to say. I'm not kind of inflating my head or anything, but I needed to find something to anchor my view of what transitory was. And there was a meta study done back in might have been 2017. I can send you the link and you can post it in the video, but it was a meta study done of 60 different papers, and it was looking at monetary policy time lags. And it said that in developed economies with, more financial, what's the word, development, I guess, they tend to
non-third world countries, maybe.
Yeah, non-emerging market, non-third world, whatever. They tend to see policy time lags of 20 to 50 months. So the monetary policy effects don't actually come into play for 20 to 50 months. Now, why might that be? I think it might come back to housing again. In the UK, for example, people tend to have their mortgages only fixed for 2 to 5 years. In the US, it's a slightly different story. You guys have mortgages fixed for like 30 years. You lot crazy. I don't know how you manage that, but yeah. But I think, it's more common for developed economies to have shorter fixed mortgages. So I think it comes back to that housing situation where if interest rates rise now, you're actually looking at a rise in your mortgage costs in 2 years, which fits with that kind of that time lag of 20 to 50 months, perhaps. I think markets react very, very quickly because markets are, financial markets are the most liquid things you can get. It's not like a hard asset where, it might take weeks, months to sell it or buy it. You can literally click. Some firms that don't even have to click buttons. They sell and buy things in 10,000ths of a second. So I think for the everyday person, it's a totally different story. They're not they're more investors than traders. And this is one thing I think that happens with us guys in financial markets is, although we are a part of the real economy, we have such a skewed perception of how people interpret, things like rate hikes and all of that. I doubt many people would understand what a euro dollars future contract is, or what the yield curve is, or anything like that, if you were to ask the man on the street. So, I think this also adds to why there might be a bit of a policy time lag. But to come back to the question where I sit on inflation, I think long term, I am not necessarily, well, I guess there's deflationary factors in my view, because I think Powell mentioned in 2021 March that there are structural inflation factors that pretty much lead to a decline in inflation over a long period of time. In the shorter to mid-term, I would lean stagflationary to potentially it being transitory and there being a policy mistake if demand collapses big time. Yeah. But I think nailed on for stagflationary. I think, if commodity prices remain sticky above, where their average has been for the last 10 years, then that's a tricky time.
It will be. So let me ask you this last question that I wanted to go into. So what's going to be the best way for you to take advantage of this current situation when it comes to the markets? What's your play right now? How are you going to how are you going to play this?
Well, I'm currently short excuse me, FDAX, so DAX futures, and I'm currently short Aussie dollar. I did want to get long dollar yuan the other day.
You missed it by about 4 days.
It just flew. Like I spoke about it back in on March 28th. I wrote an article about, I'm looking at the yuan, like I'm going to study it over the next couple of weeks and see what happened. No, didn't get a chance to study it. It just flew. So, I'm short Aussie dollar based off of Chinese demand collapsing as well. That's definitely a strong play of mine. But yeah, DAX, I think just the proximity of Germany to the conflict, I think, how they've messed up heavily in terms of their geopolitical relationships with Ukraine. People don't really like it. And also, I think that the DAX pretty much looks like the Russell in the US. It had a very, very flat 2021. And it just looked like it was primed for a drop. And I think it goes further. I think it goes down to 10K. You've got Mercedes coming up with their diesel problems at the High Court in the UK. I think, again, big German company going to weigh on sentiment. So, yeah, I think DAX is a really, really strong one. And also you've got European credit getting absolutely smashed too, which tends to be a good precursor for equities, getting smashed in the region as well.
Well, that's good. That would be interesting. That's about roughly 30% drop from where we're at. And David, I'm going to say a lot of people are going to hope you're not right. So let's. I
hope I'm not right.
Let's hope you're not right.
Markets went up all the time.
Yeah, it would be nice, wouldn't it be? Well, David, I have to say I enjoy our conversations. It should have happened like literally months ago. I'm glad that we got to catch up. We should do this more often. If I'm a trader, I'm at home and I've heard about Macrodesiac, but I want to know more about you. How do I follow your work?
Macrodesiac.com, and you can follow me, at David Bell _ on Twitter, or the Macrodesiac account. I think it's just Macrodesiac _.
Awesome. Well, it's great to catch up with you again. And like I said, we should do it sooner rather than later this next time around.
Yeah, for sure, mate. Thanks for having me.
Thanks for being here. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.